Hello, my fellow stock trading masters. This is Lance Jepson with GorillaStockTrading.com. All right, guys. Now, sweet dudes, thank you, God. Thank you for just the incredible knowledge and wisdom that you've given me that I've been able to pass on to everyone else. Right on. All glory goes to God, guys. I mean, some of you may want to chalk it up as to luck. Okay, that's cool, man. It's all good. Whether you want to say it was God or whether you want to say it's luck, it's all good, man. Okay, but guys, I'm loving the way that we've been playing this market. We've been on the right side of the trade, okay, and following these weekly updates, I mean, I couldn't ask for anything more in the stock market prediction algorithm, okay? Awesome stuff, guys. Now, I have to make an important announcement, guys, okay? And I hate to do this, okay? I really do. I really hate to do this to some of you guys, but I have to shut down the Gorilla Stock Trading blog to most non-U.S. based, non-U.S. allied countries. Okay? Listen, guys, for 7 years that I've ran my blog, I have kept the blog open, the GorillaStockTrading.com blog open to the entire world. Okay, I've done my best to do this, and I've given so much, but I can't keep doing that, guys. There's too many attacks from these various countries. Okay, now I'm not judging whatever foreign country it might be. Okay, it could be a proxy that some hacker in another country is running through a proxy because of the less government regulations and standards in that country. And so there's like this open proxy that other hackers are taking advantage of. Okay, so nobody is judging your country. Okay, but it's important that you understand. Okay, this channel and the GorillaStockTrading.com blog is for the U.S., baby. U.S. #1, guys. And that's what this blog and this channel is for. It's for U.S. markets. It's for U.S. traders, okay? Now, as somebody from the U.S., I've tried to give to the world as much as I possibly can. For 7 years, I've done that. But, guys, there's too many firewall attacks against my blog. It's taking bandwidth and usage away from U.S.-based visitors, okay? Number two, and guys, my blog is for U.S. traders, okay? U.S. investors, U.S. stock traders, U.S. swing traders, U.S. day traders, U.S. position traders, but it's for the U.S., okay? Why? Because I'm running a business, and 95% of all of my customers come from the U.S., okay? And they pay the bills, okay? Not me. They pay the bills, the contributions of other people that live within the U.S., okay? So, the entire blog and structure that is set up is, made for U.S. people, U.S. visitors, U.S. readers, U.S. traders. You know what I mean? So I can't keep, I see everybody that purchases or signs up, I see what country they're from. Okay, I'm keeping access open to the UK. Yeah, I get a tax on my website from the UK, no doubt. But I also get awesome people signing up to Jason Bomb Picks or a service, clicking on ads, whatever, through my blog that are in the UK, right? So not only is the UK an ally of the US, love you, UK guys, but you guys in the UK actually purchase and sign up to Jason Bond Picks and other stock trading services through my blog. Okay, so you help pay the bills, right? So I'm going to keep the website open to people in the UK. All right. And it was funny because I've talked to some of you guys from some of my UK trading brothers out there, and I'm like, dude, you know what? Awesome to have you, but how do you use my blog? I mean, I'm US centric based. What do you do? And oh my gosh. So it's really cool because a lot of traders in the UK, they trade in US markets. And what they do, and this one UK trader told me, he says, yeah, I work, during the day at my day job, and then at night, okay, then your markets open up, and then I trade and I make money at night. So I'm making money during the day at my day job, and then I trade US markets during the night. I was like, sweet, dude. I mean, I love that work ethic, right? I mean, come on. My UK trading brothers, you guys rock. Okay. So, I've tried to keep it open to certain European countries where I get business, right? And you guys help pay the bills. But for many, many countries, I just can't do it, guys. Now, I've been contacted by some U.S. service members that have said, hey, Lance, I'm stationed over in this country and I can't get your website. Guys, I mean, I'm so sorry about that, right? Because, I mean, here you are fighting for my freedom, okay, and putting your life on the line and so that I could do this very show. And so that's been a sticking point for me. And so I've kept open my blog for you guys for years. I mean, that's been the main reason why I did not want to do that. But guys, I can't keep doing that. You're stationed many cases in a country that's got serious problems. That's why you're there in the first place, right? So there's a lot of attacks coming from that country. So I can't do it, guys. I can't keep the blog open for you guys, Sorry, guys. I just need to let you know I've gotten some emails from some of you. Hey, Lance, what happened to the blog? I'm now getting a forbidden access message. I'm so sorry, guys. Okay? But you know what I mean? I got to keep my business up, and I got to keep things running smoothly for US, UK traders. And I can no longer continue to be so generous with my bandwidth and with access to my blog. Okay, so very sorry, guys. Okay, I just wanted to say that. I wish we lived in a world where all the countries around the world were more like the U.S., and that I got a lot of business from these other countries too, and that there were less, there were better governments, and there was less hacking, and people were free in these other countries too, just like I enjoy my freedoms here in the U.S. I wished we lived in a world like that, but we don't, guys. We don't. Okay? So love you guys. You'll still have access to my channel through YouTube, right? Because YouTube has their own security mechanisms in place, so you're always welcome to watch this weekly show through YouTube. Just no more will you be able to have the blog access if you're not a U.S. allied country or you're not within the U.S. All right, guys. So the Dow is in a strong downtrend. The S&P 500 is in a strong downtrend. The NASDAQ is in a strong downtrend. And the Russell 2000 is in a strong downtrend. The Heikin Ashi on the S&P 500, red or sell signal. The Renko, red brick or sell signal. 2 points to the bears. Institutional selling was detected on the tick on Thursday, August 20th. Institutional selling was detected on the tick on Friday, August 21st. On Thursday, August 20th, it was broad-based selling across the board. But notice that defensive utilities did the best because those are dividend-paying companies that are in there, okay? And notice that consumer cyclicals did the worst. In fact, if you split this chart down the middle with your offensive sectors on the left side and defensive sectors on the right side, even though it was broad-based selling, you can clearly see that most of the selling took place in the offensive sectors, in the consumer-sensitive sectors. Folks, that favors the bears. Then on Friday, massive institutional selling, again, broad-based. This time, even the defensive sector sold off big, but notice that, again, defensive utilities sold off the least. Nevertheless, the selling on Friday also favored the bears. 2 points to the bears for the institutional selling. 18.9% of stocks on New York Stock Exchange are trading above the 50-day moving average. Look at that plunge, folks. That favors the bears. Only 26% of stocks on New York Stock Exchange are trading above their 200-day moving average. Again, look at that plunge. That's panic selling, guys. Katie bar the door. Free fall selling. That favors the bears. Money clearly flowed into the green line, 10-year Treasury notes, and out of the stock market this last week. That's a defensive move of money coming out of stocks and going into bonds that favors the bears. Biotech, completely broken down. Risk off market. Okay, big move down that favors the bears. The Ichimoku on the Russell 2000 still favors the bulls. The S&P 500 to the NYAD, they're tracking fairly closely. No positive or negative divergence, no signal this week. The McClellan oscillator, red below the zero line, favors the bears. The pivots clearly below. Now, not only is it underneath the pivot level on the Russell 2000, but it's taken out S1 and S2 support levels. That favors the bears. S&P high-low index going back and forth between blue, red, no signal this week. The S&P 500% of stocks above the 50-day moving average with our EMA envelope lines. Look at that, guys. Unbelievable plunge below the EMA envelopes that favors the bears. The S&P 500 to XLI. Folks, we picked up a negative divergence on the previous weeks where XLI was breaking down while S&P 500 was going sideways. But look at what happened this last week. The S&P 500 basically caught up to what XLI was doing. Okay, so they're both, following each other fairly closely, tracking closely. No positive or negative divergence was picked up, so no signal this week. The Guerrilla Stock Trading Sentiment Indicator, we are way in excessive bearish sentiment territory. Look at that, folks. But we do not have a turn up on the CCI. In fact, the CCI has just exploded to the negative side. Not until the CCI rises above the negative 100 level would that be a contrarian buy signal. Okay, so no signal this week. The S&P 500 to high yield debt. Guys, I've been talking about the breakdown in high yield debt for a couple of weeks now. And last week we really saw the high yield debt broken down, and I told you guys that the S&P 500 follows the high yield debt usually within the next week when it starts to move down, and that's exactly what happened. So because this indicator allowed me to accurately predict that move down in the S&P 500 so accurately, okay, from now on this indicator will get 2 points instead of just 1 point, and I'm gonna up that score level on an ongoing basis until I feel that I've tweaked it just right. Okay, so for now, this indicator is going to be worth 2 points each week. Okay, now for this week, they're tracking nicely. There was a negative divergence that was picked up earlier in August. You could see the big plunge where the S&P 500 was just going sideways. Okay, but now the S&P 500 has fallen in line with the high yield debt. So no signal this week. The Elder system applied to SPY in the daily time frame gives us a red high-low bar or a sell signal. The S&P 500 in the weekly time frame, Elder system, sell signal, sound the bear siren. Total carnage on Wall Street, guys, and we've been able to stay out of it. Very, very nice, folks. The PPO applied to SPY. Clearly, it's broken down over the last few days, and that favors the bears. VIX short-term futures, unbelievable, huge move up. Strong uptrend on the VIX short-term futures. That favors the bears. VIX midterm futures, again, big move up, break above the 50 EMA lines. Strong uptrend that favors the bears. And finally, you could see that the S&P 500 has broken below this sideways trading channel that we've been in for many, many months. For, in fact, most of 2015. In fact, the S&P 500 once again has gone negative for the year, folks. That means that you would have been better off holding bonds, holding CDs, holding money markets than you would in the S&P 500 this entire year. Had you bought at the January 1st, 2015 and held all year long, you would be up more in those instruments than you would in the market. And then if you calculate or figure in slippage, that is your broker's fees, oh man, it's not even close. You would have just dominated had you just been in bonds or a guaranteed interest rate. Okay, that's spooky, folks, because as more traders, I talked about this a couple weeks ago, as more traders realize that, that's going to make people want to buy guaranteed bonds more than stocks. And that's exactly what we saw this last week. Now, the slow stochastic was never really at a good signal point. We never really had a signal on this for, several weeks now, because it was right in this middle. And like I said, we always want to get the excessive bearish or excessive bullish, signals, okay, somewhere in this buy zone or somewhere in the sell zone. Well, look at this, guys. We've broken into the buy zone. It's not time to buy yet. We have to get the cross of the %K and the %D lines within one of these zones. That's our signal, okay? But we're getting closer to such a signal. Look at that plunge, guys, okay? No signal yet. Get out of the way. Let the market fall. Don't try to catch a falling knife, right? But at least we're getting to finally set up for a good signal rather than this no signal sideways move on the slow stochastic. And then the ADX line, the negative DI line is way on top, surging higher. And the scary part is that you've got the ADX line turning up too. And when the ADX line rises, it means the market is trending. So now we've gone officially into a down trending market. Folks, looking at all the aspects of this chart, it favors the bears. My rating for trading next week is that the bears have a strong advantage over the bulls going into trading next week. On Tuesday, August 25th, we have new home sales. On Wednesday, August 26th, durable goods orders. On Thursday, August 27th, the all-important GDP and jobless claims. And then on Friday, August 28th, personal income and outlays. Also on Thursday, August 27th, we have the economic speeches from various global economic and financial leaders coming out of good old Jackson Hole, Wyoming. So keep your eyes on that. And that continues through Friday. So on both on Thursday and Friday, we could see some headline news coming out about various things said about the economy from Jackson Hole. The week started off really bad with the economic fundamental reports that came out. And the Empire State Index led things off. Now, the Empire State Index plunged to minus 14.92 in August for its weakest reading since April 2009, folks. Oh, new orders fell to minus 15.7 for the weakest reading since November 2010. Oh, man, guys. Shipments fell to minus 13.79 in the weakest reading since March of 2009. Folks, the rising rates and U.S. dollar environment that the Federal Reserve has put us in is clearly contracting the economy. As I talked about in last week's show, the Fed has already started contracting the economy. The Fed is employing contractionary monetary policy. Just by talking up like there's going to be a rate hike at any time, they pushed rates up. I mean, yields were up, what was it, 200, 300, 400% 8%, over the last few months as they pushed, up the idea that in September they were going to be raising rates because the economy was going to strengthen, right? The transitory thesis, which I said several weeks ago, that's now been proven false. I think some of the downward move in the markets are traders and investors pricing in that new reality that Janet Yellen was wrong about the transitory thesis. But now, guys, okay, Econo Day charts the Empire State Index every month. Check out this scary looking chart. Look at that, folks. That should make the hairs on your arm stand up. Oh, man. The Federal Reserve's rising rates environment has weakened exports in the energy sector, and this is contracting the factory sector much too quickly. The Federal Reserve is hell-bent on raising rates. Obviously, Janet Yellen and the Fed are not letting the economic data guide their rate hike agenda. Okay, that's the other big lie. And you guys know I've talked about that. I even did a funny graphic on that. And in fact, several of them, right? That Janet Yellen and the Fed are hell-bent on this rate hike. Now, some are saying, well, it's because they have to raise rates because they need to get the rates up before the next bear market cycle, and they're running out of time because if they don't, then they're not going to have any leverage to lower anything. They're not going to be able to stimulate by lowering the discount rate because it's already so low. So they're running out of time. So they got, but wait. Okay, I'm not going to discount that, right? I mean, that's a decent point. But the bigger point is, what are we talking about? Why are we talking about, well, the Fed's running out of time. Rates are so low and they're running out of time. And so therefore they better raise it so then they could hike it again or they better hike it now so then they can lower it again in the future and have some wiggle room. What are you talking about? If they hike it when it's so weak, it's going to crash it and make everything worse. To hell with them having their wiggle room, right? And what are we talking about? The Fed needing to even do that? I thought things were going to be so much better. I thought that the lower interest rates was going to stimulate everything and make everything go. Why are we even talking about this idea that they have to raise in order so that they could lower when the next bear market hits? What? If that's your economic policy, then it's a failure. That's just so stupid at so many levels. Look, guys, there's only one reason to raise rates ever, and that is to fight inflation as the economy overheats and gets too hot. And inflation starts to go up and prices start to go up. Okay? Things really start going crazy bonkers. Everybody starts raising their prices because they can, because people always pay it. And there's this money awash everywhere, guys. Right? Everybody's working, making money, buying this, buying that. They're consuming so much. Businesses just keep raising their prices and everything just keeps going up and up and up and up and up and up. Right? That's when you want to step in and kind of slow things down, make it more gradual going up. Okay? All right, so that's why you raise rates. That's the only reason why you ever raise rates. The only reason why you ever lower rates is that the economy is rolling over, going into a bear market, prices are spiraling downward, people are getting laid off of their jobs, consumer spending is plunging, right? So to stimulate the economy, you lower rates. Don't make this more difficult than it has to be. That's a central aspect of Keynesian economics, guys. Anything else is just blah, blah, blah. Oh, well, the Fed has to raise now, not because the economy is strong, but so that they can have wiggle room in the future when we go into the next bear market so that then they can lower. No. We're so weak right now, the Fed will make it worse by trying to raise rates when the economy is too weak. They'll make everything more worse. To hell with their ability to go back down. They're going to make it so damn worse by raising it in the first place that them going back down is not going to do much. And then they're going to have to try to go negative interest rates, which is a joke, right? So we don't even want to get there, guys. So keep your economics, keep your macroeconomics simple. Keep your macroeconomic analysis simple. You raise rates when things overheat. You lower rates when things crash. Okay, that's it. Now, in my opinion, the Fed talking up rates all this time, they've over raised rates. They've been jawboning rates up, and they've been very effective at doing that, saying, oh, rate hikes is coming any minute now. Rate hike's going to just right around the corner, rate hike. Right? Oh, yeah, no. We're letting the economic data set our rate hike agenda. I told you guys, 6-7 months ago, I said that's bull. They're not letting the economic data guide their rate hike agenda, because if they were, they would have said months ago, we're not going to raise rates in September. In fact, we won't raise rates this year. I told you what the Fed needed to do like a month ago. They should have come out and said no rate hikes in 2015 and likely no rate hikes in 2016 either. That would have calmed markets. It's off the table, guys. That's what the Fed should have come out and said. The Fed also should have come out and said, and we're going to defend the U.S. dollar. We're not going to watch the U.S. dollar be destroyed by other countries devaluing their currencies and destroying our exports. The U.S. is one of the biggest exporting countries in the world. Okay, we're not going to stand by and watch our U.S. exports tumble, our manufacturing and industrial sectors plunge because everybody else is cheating and devaluing their currency. We're not going to do it. We have to defend the U.S. dollar. It's gone on too long. Okay, the dollar's gone up too far, too fast. It's crashing things. Look at the Empire State Index. Okay, the lowest since 2009, right? So we're going to step in and we have to defend the dollar, so we're going to devalue the dollar. Okay, that's what the Fed should have done like a month ago. That would have kept things going. But the Fed did not do that. Okay. Now, the Federal Reserve is hell-bent on raising rates. Obviously, Janet Yellen and the Fed are not letting the economic data guide their rate hike agenda, else they would completely back away from a rate hike as the U.S. economy continues to slow. The only thing that makes sense is that the Fed is racing to raise rates is because inflation is really much higher than what the numbers show. In fact, it may be so high that actual GDP may have crossed above potential GDP back in 2012. If you take the real potential gross domestic product and then the gross domestic product and you chart them, you could see that that's exactly what happened. Now, I'm not going to explain, this chart and why I say that. I did that in last week's show on why I didn't use real for both. Okay, but so you can go back to last week's show if you want to see that. In the traditional Keynesian model, the steps to reduce inflation, okay, are when the aggregate expenditures, okay, on this vertical line and real GDP output on the horizontal line, when the equilibrium that is established between the two is at a level that is greater than the potential GDP, like in the chart I just showed you. Okay, here's another way of looking at that exact same thing. And here is the potential GDP, okay, output line. So when the market equilibrium is established to the right of that, it creates inflation. There's an inflationary gap. So then they do inflation lowering policies. They raise interest rates, and that's exactly what we're seeing the Fed do. So the Fed has to reduce aggregate production and aggregate expenditures, which will contract the GDP. And that's exactly what they've been doing, as evidenced by the Empire State Index. Look at the big plunge. This is going to hit GDP. The Fed is contracting the economy right now. They've already started, okay, and this is pushing down the GDP. Now, many people talk about interest rate hikes as if it's something that's coming. They say, oh, the Fed can't raise interest rates. Reality check. The Fed began raising rates more than a year ago, as evidenced by the slow climb in rates. Yes, the Fed is holding the discount rate down, but a rising rates environment is not just about the discount rate. Then on Tuesday, August 18th, we had housing permits fall by 16% in July. Housing permits fell negative 16% in July to a 1.119 million annual rate. The decline in housing permits points to less growth than expected for the new home market in the months ahead. Now, here is a housing starts chart that I did for you guys, okay? And the brown line is housing permits, okay? The yellow line is multifamily. The blue line is single family. And then the red line is housing starts. And you could see, look at housing permits. Look at the plunge in housing permits, folks. The only reason why housing permits was going up back here was, remember, it was the multifamily component. Remember the big multifamily move here? Okay, and so that's why we were saying, oh, well, yeah, I mean, you know, that's awesome that housing permits and housing starts are moving, you know, up like that, and that housing permits did a breakout, and oh my God, look at housing permits go. But then it was like, whoa, whoa, whoa. It was mostly from multifamily, which is apartment complexes and building. Also, rising rates are going to make it harder to finance the building of a multifamily complex. Okay, and so you could see, sure enough, the big plunge in housing permits. Look at what happened to multifamilies. It fell. Now, the S&P 500 sold off big on the news. You could see that on August 18th, Tuesday. Here's where housing starts came out at 8:30 a.m. and look at what the S&P 500 did. It plunged. I warned you guys last week. Don't be saying that, well, isn't bad news good news and good news bad news, because then the Fed is going to taper later than they normally would, which that's going to make it. And I told you, don't confuse yourself. Okay? If that was the case, and we do go through periods in the market where bad news is good news and good news is bad news, I will let you know when we're in a market like that. We're not in a market like that, and I told you guys that last week, okay? Just keep it simple, baby. Watch the market. If you're wondering how to think about a fundamental economic data report that comes out, look at how the market responds to it in real time. Don't wait for the end of the day and try to look at a day candlestick. Watch the S&P 500 in real time as that fundamental economic data report comes out, and watch the way traders respond to it. That will tell you how you should think about it, whether you should be bullish about it or bearish about it, okay? All right. So you could see at 8:30 a.m., housing starts came out, and look at the big sell-off. Bam! CNBC's Leesman says expiration of a large tax break for new construction in New York State may account for much of the shortfall in July building permits data. Well, you know, Steve Leesman gives himself more credit when he's not always being a perma bull. Okay, Steve Leesman faults Peter Schiff for being a perma bear, and rightfully so. But then he turns around and soft coats, sugarcoats, and plays a perma bull on almost everything. You know? So Steve Leesman needs to be a little bit more balanced in whether he's bullish or bearish. Okay, but that's just my thoughts. All right. So the problem with Steve Leesman's logic that a big tax break for new construction in New York State may account for much of the shortfall in July building permits data has a problem. Okay? And that problem is that permits didn't just fall in the Northeast. Okay? In the report, we could see the different regions in the U.S. Duh, right? Come on, Steve Leesman. Permits fell in the other three regions, including a sharp negative 9.9% fall in the West. It's got nothing to do with the New York State tax break that Steve Leesman was talking about on CNBC, right? Okay. So the housing starts report is exactly what we would expect in a contractionary rising rates environment, with both the Federal Reserve using contractionary monetary policy, right, by talking up the threat of a rate hike like they've been for the last year. Okay, so rate hikes go up anyways. The dollar goes up anyways as traders go to play the rate hike, right? Okay, and the U.S. government using contractionary fiscal policy. That is raising taxes, raising EPA standards, raising minimum wage, raising labor costs. Okay. Stock traders track the housing starts report because of the powerful ripple effect new home construction has across the economy. New home construction helps raise construction employment, and that income is pumped back into the economy. When the home is sold, it generates revenue for the home builder and mortgage lender. Many other industries also benefit because new home buyers often purchase refrigerators, furnitures, washers and dryers, landscaping services, home alarm systems, and so on. This creates a powerful ripple effect across the economy. The FOMC minutes from the July 28th and 29th meeting was released on August 19th. Now, rather than coming out at 2 p.m., somebody leaked it. There was a leak inside, and it hit a major news syndication service at somewhere around 1:35, 1:40 p.m. So then the Fed just, oh man, it leaked. So then they just turned around and they just let the whole thing out to the entire public. Okay, so it came out a little bit earlier than 2 p.m. Okay, but in any event, guys, all right, first of all right, the FOMC minutes tanked Treasury yields. Okay. And it basically tanked the stock market. But bravo, Janet Yellen. Bravo, Fed. Okay. Guys, I was so mad last month. I told you I'm not even going to waste my time analyzing the minutes and going over them, right? Because they didn't even mention the rising U.S. dollar, the crash in the energy sector. It was a joke the last minutes, right? I was like, what is going on? I'm not even going to waste your time or mine looking at the minutes. This is stupid, right? Fast forward to this month on Wednesday, August 19th. Bravo. Bravo, Fed. Bravo. They were honest. They were finally flipping honest, guys. Okay? I know. It's sold off the market. You're like, oh, I didn't like their honesty, Lance. I lost a lot of money. Okay, but guys, I get that. But let's don't live in a world where we're all too stupid and the government and the Fed all has to lie to us because they have to control our minds and the way we think. I mean, that's basically saying what you want if you're upset that you lost money. You shouldn't have lost money. Had you watched my weekly show every week, what did I say? Sidelines rating, right? Should be out of the market and on the sidelines in the safety of cash. If you play a market on the long side, you should have what? A tight stop loss put in place. I said that, right? So just blame yourself. But in terms of the FOMC minutes, I loved them, guys. They were much more honest. They talked about the things that needed to be said. Now, several participants expressed concerns about China. Most voting members say that the economy is not strong enough yet for a rate liftoff. Most members thought conditions were not yet appropriate for a rate liftoff, but that we are approaching those conditions. In other words, the Fed is trying to talk up rates. No, we're not. The economy has been slowing. We're not approaching anything. Okay? Obviously, the Fed is on a preset course to hike rates, right? And so they're not letting the economic data guide their rate hike agenda, right? We've been talking about the slowing economic fundamental data this entire year now, right? The transitory thesis. And how I said several weeks ago, that's blown up now, right? So the market's pricing in the new reality that Janet Yellen was wrong, okay? We're not approaching anything. If they're going to hike rates, they're going to hike rates because they want to hike rates for whatever reason, but it's not being driven by economic data. And they're not hiking rates because the U.S. economy is just getting so strong and it's heating up. You know what I mean? Obviously, that's not what is going on. I'm thinking that inflation is a problem. That is, actual GDP has crossed above potential GDP, not because the economy has really strong and just taken off, but more because of the trillions of dollars that the Fed and that the U.S. government, okay, have pumped in to the economy. It's distorted things and it's pushed the actual GDP above the potential GDP rather than the free market doing it from a strengthening consumer. Further progress towards goals was seen, but many officials felt more progress was needed towards lowering labor market slack. The labor market was at or very close to maximum employment for this bull-bear cycle. Isn't that interesting? The Fed is just basically thrown in the towel on that statement. Well, the labor market is at or very close to maximum unemployment. We can't expect anything more from the labor market for this bull-bear cycle. Creepy, guys. But hey, at least they're telling us the way they feel. You know what I mean? At least it's honest now. Downward pressure on inflation from energy and the U.S. dollar, okay, thank you for finally mentioning that, was expected to abate. Why? Why was it expected to? China's devaluing their yuan. Now, granted, China did that after the July 29th FOMC meeting, which is what these minutes are from. So, okay, fine. Some participants also discussed the risk that a possible divergence in interest rates in the United States and abroad might lead to further appreciation of the U.S. dollar, extending the downward pressure on commodity prices and the weakness in U.S. exports. Exactly. Now, look at what happened to Treasury yields, folks. They plunged, okay? So here is the 5-year Treasury note yield, and look at this. Right around when the FOMC minutes came out, right, they were scheduled to come out at 2, but then they leaked, and the Fed scrambled to let them out at like 135. But you could see exactly what happened. Look at how Treasury note yields plunged, guys, on the FOMC minutes. Plunged. The drop in Treasury yields suggests that most traders view the FOMC minutes as pushing back the date for a rate increase as the U.S. economy continues to slow. The complete collapse in oil prices puts disinflationary pressures on the U.S. economy. Also, the slowdown in China could pose risks to the U.S. economic outlook as a number of large U.S. corporations have exposure to China. I actually heard a guy on CNBC this week say, China's not China's gonna go down, but it's not gonna have an impact on the U.S. And this guy was a money manager. I mean, some of those guys, they're just bullish cheerleaders. They're like perma-bulls, and they nuts, guys. I'm sure glad that guy's not managing any of my money. Most traders viewed the FOMC minutes in a bearish light and bought more defensive bonds, okay, on the FOMC minutes. Money moved into bonds, right? And as money moves into bonds and the price of bonds go up, yields goes down. So that's how you know that most traders viewed the FOMC minutes in a bearish light. Then on Thursday, August 20th, we had the Philadelphia Fed Business Outlook Survey. The Philadelphia Fed Business Outlook Survey came in at 8.3 for August. Guys, that's a tiny little move up from the 5.7 reading in July, and that shows a weak business environment. This index has plunged since the beginning of 2015, far below the highs of 2014. The demand for manufactured goods, as measured by the survey's current new orders index, remains low as well, falling slightly more than 1 point to 5.8 in August. So here's a chart of the Philadelphia Fed survey. Okay, look at that, guys. That's it. That's the pathetic little move up. What the heck is that, dude? What the heck, man? That's like nothing, right? Look at where we were in 2014, right? Not even close to those numbers. Oh yeah, the economy is going to pick up speed. Now the S&P 500 plunged on the Philadelphia Fed Business Outlook Survey. Look at what happened, guys. The Philly Fed Business Outlook Survey came out at 10 a.m. Eastern Time, and look at what the market did. Boom. Now, stock traders track the Philly Fed survey because the stock market likes to see healthy economic growth because that translates to higher corporate profits. The bond market prefers more moderate growth so that it won't lead to inflation. The Philly Fed survey gives a detailed look at the manufacturing sector, how busy it is, and where things are headed. Since manufacturing is a major sector of the economy, this report has a big influence on market behavior. Then, folks, something very interesting happened. Also on August 20th, Thursday, existing home sales came out. And dudes, existing home sales rocked. The existing home sales report showed existing home sales up a stronger than expected 2% in July to a 5.59 million annual rate. Sales are up 10.3% year on year, with the median price rising 5.6% to $234,000. Now check out this strong uptrending chart in existing home sales. Look at that, folks. Breakout and boom, right? Oh man, that chart looks really bullish. Awesome. Okay? But I mean, wouldn't you think that the market would have gotten a really good, at least a little bit of a bounce out of that? Well, look at what happened, guys. The existing home sales came out at 10 a.m. Eastern time, and look at what happened. I mean, that's it. I mean, it just kept falling. In other words, the honey badger bear didn't care about the existing home sales reports. Dudes, it's the honey badger bear. Little badass little honey badger bear walking around. Oh, good economic data? Don't care. I don't give a shit about your good economic data. Right? We're in the weakest 6 months of the year. Honey badger don't care about your good economic data. Honey badger doesn't give a shit. Stock traders track existing home sales because of the multiplier effect through the economy. People have to be feeling pretty comfortable and confident in their own financial position to buy a house. Once an existing home is sold, it generates revenues for the realtor. Home buyers often purchase refrigerators, washers, dryers, and furniture. The economic ripple effect can be substantial. The yield curve has been flattening over the last 3 months at a rate that appears to be beyond just the normal ebb and flow and what I call the heartbeat of the yield curve. Okay, the yield curve gets a little bit steeper and then it flattens a little bit, gets a little bit steeper and flattens a little bit. It's like a freaking heartbeat for the economy. Now, what launched me into fame years ago, and you could go and see this video, it's still on my channel with over 70,000 views, was how I told everybody what the Fed was doing. They were going to try to, there's all these theories, and Peter Schiff was saying stuff, and I'm like, no. The Fed is looking at the yield curve. They want to keep the yield curve steep. A steep yield curve is the difference between short-term rates and long-term rates. And banks borrow short-term, loan out long-term, and make money off the spread. So the Federal Reserve, in order to help banks, right, help the financial sector, because they got hit the hardest with the global financial crisis, right? They were going to try to keep the yield curve steep at all costs. And I said they were going to be able to do it, and it was going to allow President Obama to say that the economy got better under his watch, and he would be elected for a second term. And I said that back in 2010, and I was right. Okay. Most people didn't even notice it, but a lot of you, 70,000, views, a good amount of people did notice it. Okay. And that really got me on the radar, at least, over YouTube, with a lot of people following my channel. So I know what I'm talking about when it comes to the yield curve, folks. And I have a history of being able to accurately read the yield curve. Okay. So now I'm telling you that the yield curve has been flattening over the last 3 months at a rate that is inconsistent with the normal heartbeat. It's not flat yet. It hasn't gone inverted yet, which would be a flat out bear signal, but it's flattening at a rate that is not normal. So yellow warning flag, guys, not red sell flag, but a yellow warning flag. Okay. So here is a chart of the 3-month Treasury yield, so you could see what's going on. Okay, this is our short-term yields. Okay, you could see for the last 3 months, right? And we're currently, this is a performance chart. So in the last 3 months, we're at 0%, and that makes sense, right? Because short-term yields are impacted more by the Fed's discount rate adjustment than long-term yields are. Okay. So the fact that short-term yields are hovering at about a 0% gain over the last 3 months makes sense. It also gives you a clue. It also makes a lot of sense. This big run up that started in July and that ran up an incredible 500% in early August, right? Because traders were gaming the first federal rate hike. They were pricing in a Fed rate hike in September. Okay, because when the Fed raises that discount rate, they raise up rates, okay, it's going to raise up the 3-month yield rates also. Okay, they're raising short-term rates. So traders were trying to game that. Look at what happened, guys. And then in early August, the market started pricing in the idea that Janet Yellen was wrong about her transitory thesis. The economy was not getting stronger. Okay, and the Fed was going to have to push rate hikes back. And then the FOMC minutes confirm that, and look at what happened. It's come crashing back down. Okay? So it completely makes sense. The big run-up in short-term yields in early August was bond traders timing a September rate liftoff. As the economy has continued to weaken and countries around the world continue to devalue their currencies, which hurts U.S. exports because it pushes up our U.S. dollar, the FOMC minutes released on August 19th made more traders believe that a rate hike will not happen in September. In fact, some think the economy is too weak to raise rates at all, and the Fed will ultimately need to devalue the U.S. dollar in order to defend the U.S. dollar in the global currency wars. And that's why gold is starting to surge higher. Now, check out what long-term yields, 30-year yields, have done for the last 3 months. Okay, look at this. So rather than short-term yields were holding at 0% over the last 3 months, right? They spiked in early August when they came crashing back down. Okay, but look at what the 30-year, the long-term yields are doing. Okay, they're down 10% over the last 3 months. In other words, if we were to graph out all of the yield charts and the 2 yield charts I just showed you onto a single chart, that would be the yield curve. Okay, and that's published on stockcharts.com. And here is the yield curve with all of our short-term rates along this horizontal line. And you could see, now I turned on the trailing history on stock charts, which it shows you where rates have come from recently. Okay, and look at what's happening, guys. Look at how the long-term end of the yield curve is coming down. See the gray area? That's where it's really coming down. Okay, while the short-term rates are largely fixed because the Fed is holding the discount rate steady at near 0, right? So look at that, guys. The yield curve is still normal. It's still good, but it's starting to flatten. And this big move is more than what you typically see. You typically see a gray area that's much smaller, and it goes back and forth, up, down, up, down, up, down. This is just down, 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 down. So yellow warning flag, okay? Keep your eyes on that. Now, banks make big money off of a normal to steep yield curve. They borrow money short term, loan it out long term, and make a point off the and make a profit off the spread. When the yield curve flattens, there's less profits to be made by banks. And that's why bank stocks have been hit hard over the last few weeks. Check out the Spider Bank S&P ETF. Look at what's happened, guys. Okay, it's gotten hit hard. The Spider Bank ETF is down 7% over the last 2 months as the yield curve has been flattening at a quick pace. As yields come down with the flattening yield curve, the big winners are stocks that trade in the utility sector because of dividends, right? So these companies that pay dividends now, it's more competitive than ever. Why buy treasuries, right? Their yields, it's starting to flatten, it's starting to come down when you could buy a dividend stock that pays a lot more. So utility stocks are dividend payers. And that's why utility stocks are defensive stocks in nature. People that want to get those dividends, right? So utility stocks dividends are more attractive as bond yields come down. And that's why over the last 53 days, utility stocks are squashing. I mean, they're trumping all other sectors. Check out the last 53 days and this chart that I did that you can see. Look at that. Utilities up 8.35%. The nearest sector to that is the defensive consumer staples, up just 3.75. So that's unbelievable. Utilities are just like running away from the rest of the market. And that makes sense. Now, institutional trader selling was detected on the tick, right, on both Thursday and Friday. And what was really noticeable is how the offensive sectors sold off, but really focus in on just two: the offensive consumer discretionary cyclical sector, right? That follows the stock market cycles, right? Okay, our sector rotation wheel, okay? So, and that's why these are cyclical stocks, right? Because the bull bear cycle, these offensive consumer sensitive stocks rally when the economy's strengthening and then plunge during the bear market cycle, right? So if you look at consumer discretionary cyclical stocks versus the consumer staples sector, right, which is the more defensive, bigger companies, slow moving, the oligopolies in, big food processing corporations. Nothing really exciting to write home to mom about, but they do better. They're a defensive sector. Okay, look at just these two sectors. Look at what happened on Thursday in the institutional selling. The cyclicals, the offensive consumer cyclicals, or the consumer discretionaries sector, plunged negative 2.8% on Thursday when the tick picked up the institutional selling. But look at the consumer staples. It only fell 0.9%, less than half of what the cyclicals fell. Very telling, folks. If you subscribe to my blog at GorillaStockTrading.com, you get this yellow bar across it. And guys, I monitor the news and often will push something out way before the mainstream news gets it. Okay, so if you live in the U.S., do sign up. It's a free service to register on the GorillaStockTrading.com blog. But I pushed out in the overnight market how the flash manufacturing PMI came out of China, came in at 47.1. That was the lowest level since March 2009. The estimate was for 48.2%, which that was bad, but the 47.1, it was badder than bad. Output, new orders, and new export orders all are decreasing at a faster rate than people had originally predicted that it would. The manufacturing PMI out of China suggests that China's economy is still trying to find a bottom. It hasn't bottomed yet. Now, overall, the likelihood of a systemic risk remains really low, guys, because China's economy still is growing. Keep in mind, we're talking about a slowdown in GDP. We're not talking about negative GDP, so don't get too caught up in that yet. Here is the overnight S&P 500 futures that I pushed out, okay, on the blog. And you could see in real time, here's where the news broke, okay, at about 6:30 p.m. in the U.S. So our markets were closed and the news cycle was done for the day, okay? That's when, China's day starts, and China and the PMI number came out from China. And look at what the markets did. This big circle is the PR that hit, and look at how the futures plunged. Okay, so I pushed that out to you, right? And, guys, so it was not a big shocker that the market plunged the next day, right? So the China PMI manufacturing data came in below expectations for a 6.5-year low. And this confirmed fears of weakness in the world's second largest economy, and it increased the likelihood of a possible hard landing in China. And that spooked everyone. North Korea's Kim Jong-un has given orders for the army to go into a state of war. And Greece Prime Minister Tsipras' resignation may just be a trick. It may be Greece trying to renege on an EU bailout deal. German government spokesperson Seibert says he is not surprised by the resignation of Cyprus, and he expects Greece to continue with implementation of reforms under the new aid package. German finance minister spokesman Weisgerber says that a delay in Greek reforms would delay aid payments. So the resignation by Cyprus could be nothing more than a trick for Greece to try to get a better deal from EU creditors, guys. Okay, so, Greece could be heating up again. Keep your eyes on that. Keep your eyes on China. China still is in play. I told you guys in last weekend's show to watch China. Okay, keep watching China. That's going to be the biggest impact on our markets. And then news has come out over the last few hours that apparently some shots are being fired between North Korea and South Korea along the demilitarized zone, and U.S. troops were picked up moving along the border there. So that could also heat up, but that does seem to heat up, over and over and over again every so often. And it usually doesn't lead to anything. It usually just kind of dissipates out over a few days. But nevertheless, keep your eyes on that as well. Overall, stocks took their worst pounding in 4 years this week, and the S&P 500 has gone negative for the year. Now, traders are going to be looking to see if China steps in and does something big. Let's just hope that whatever that big something is that China does, that it's not in some big devaluation of their yuan. Because as we saw earlier, U.S. markets do not like that. Keep your eyes on China's market on the news cycle Sunday night, folks. Okay? Sunday night in the U.S. is when you want to start, looking at your news feeds for what's going to happen in China. Is China going to step in and do some massive stimulus and inject some money or some type of QE type program? That's going to be what traders are watching. Some of you have written in and said, well, Lance, do you think I should short this market? Absolutely. If the bears have a strong advantage over the bulls like they have in this week, absolutely you can go for some short trades. Just make sure to keep some good stops in place and don't get too greedy. Markets have a tendency to slowly roll over on the top and make it easy to read charts and signal their moves, but on the bottom, they generally tend to have V-bottom bounces, which are much more difficult to time. So you're trying to make money on the short side in the mid-range section of the move, somewhere between where it started to roll over and where it ultimately bottomed. So that means you can't get greedy. Bulls make money, bears make money, but pigs get slaughtered. Don't be a pig. As for me, I told you guys several weeks ago that in my big money, in my 401k, I moved it all into bonds weeks back. So I'm sitting pretty, guys. I do have a trading account through E-Trade where I do more active trading, but with a much smaller sum of money. But my big nest egg, my big 401k, I'm all in bonds. I think that we should be more worried about playing defense than we should with picking a bottom. Okay, it's easier to play defense than it is in trying to time a bottom. I heard this awesome quote on CNBC earlier today that said, fear the guy that has to sell, not the guy that wants to sell. Okay, what's happening, and I talked about this in January, okay, that the sovereign wealth funds are valued, the top sovereign wealth funds have over $5 trillion worth of assets, okay? Out of the biggest sovereign wealth funds on the planet, and you can Google this, Google sovereign wealth funds and do the research, right? You'll find that most of them are oil-based, okay? So what happens is that they were extended large amounts of margin accounts because of their large oil holdings, because the oil was seen as a relatively safe hold. So they had some really sweet margin rates, okay? They turned around and they took that margin and they invested in equities, okay? Now that the price of oil is just plunging down. As oil drops, it's like a global margin call goes out to everybody, not just sovereign wealth funds, but everybody. So they either have to put new money into the market or they have to sell their stocks and get out to reduce their margin level, right? Because their oil holdings were underwriting much of that margin debt. Okay? So again, fear the guy that has to sell, not the guy that wants to sell. Okay? That's the kind of market that we're in. And this and over the last few days, these were people that had to sell. They were hit with margin calls because of the plunge in the drop of oil. Okay? Those are the guys to be scared of if you're a bull, not the people that simply want to sell. All right, you guys, be safe. Thanks for listening. Love you, and talk with you soon.